Welcome to Economics. Should food be included in the Reserve Bank's inflation targeting framework, or should Reserve Bank only target non-food or core inflation? This debate was seemingly settled in 2016 when the Reserve Bank decided to target the headline inflation, including food. But the debate has resurfaced again this month, with Commerce Minister Piyush Goyal asking for a rate cut from the Reserve Bank despite inflation jumping to a high of 6.2% in September entirely because of food. Goyal demanded that policymakers and Reserve Bank sit and discuss if food inflation needs to be part of Reserve Bank's target. Now, the Finance Minister also seemed to agree with this demand when she told CNBC-TV18 that we need to have more conversation on inflation interest rate dynamics. Just hear them out and we'll continue the conversation.
Global markets don't go by your demand and supply ups and downs. They want a consistent flow of pulses to come into India. So complex issues, but very much affecting the common man. So inflation gets actually very, very volatile because of the supply-demand constraints. The cost of borrowing is really very stressful. And at a time when we want industries to ramp up and move building capacities, bank interest rates will have to be far more affordable.
I certainly believe they should cut interest rates. Growth needs a further impetus. We are the fastest growing economy in the world. We can do even better. And frankly, the largest component of inflation is food inflation. I think it's an absolutely flawed theory that food inflation should be considered while deciding on the interest rate structure. Food inflation has nothing whatsoever to do with managing inflation. That's a demand-supply situation.
Well, more conversation needs to happen on this issue, are what both ministers are saying, and we are going to do just that today. Joining me are Professor Pulapre Balakrishnan of the Center for Development Studies, Thiruvananthapuram, Sonal Verma, Chief Asia Economist at Nomura, and Rupa Rege Nitsure, the economist who was part of the Urjit Patel Committee, which authored the Flexible Inflation Targeting Framework back in 2015. Ladies and Dr. Balakrishnan, thank you very much indeed for your time. Well, Sonal, let me start with you. In the first place, is this demand got anything to do with the academic debate on whether food should be included in the target? This appears to be that the government is worried. The second quarter was bad. We had poor, IIP numbers, core sector numbers, and even nifty results. Earnings growth was just in single digits. And so they're just passing the buck to the Reserve Bank. Is that what we are witnessing now?
It's possible, Latha, that the current trade-offs are so stark that we are having this debate. But it's good to have this debate because, we could face shocks on both the sides. There could be a scenario where food inflation is actually very low, but core inflation is much high. And then the debate actually would be, do interest rates need to be cut at all, or should we be hiking rates? So I think we do need a fundamental debate about what is the right metric to target. I would also say that, I stand on the side that we cannot just exclude, 40+% of the CPI basket at all. I mean, we know that food impacts, expectations, etc. But I think we also need to have a debate on, food is a very broad, comprehensive basket. Within food, have certain items which are very volatile and other items that are more persistent.
1 minute. Sonal, I will come to the theoretical. I'll come to the theoretical part in just a minute. Okay, let me get first thoughts on what is the immediate issue, because markets are trading and they want to have an idea of what's the immediate impact. That's why. Dr. Balakrishnan, your thoughts. Do you think that we can look through, or the MPC must look through the current food increase? Core inflation has ranged between 3 and 3.7% in the last, in this entire calendar 2024. And it's only food that has taken the headline CPI above 6%. Can the Reserve Bank and the MPC, or should the Reserve Bank and the MPC look through this food inflation?
I would say that you should start, or we should start with an idea of what our inflation index should be, what it should contain, what goods. And from that point of view, there's no question of keeping food out of it, right? The question doesn't arise. And I'd like to make a small point, Latha. You said that in 2016 or whenever the Reserve Bank decided to target headline inflation, i.e. an index with food, I just want to say it was not just the RBI, but RBI in agreement with the government of India. Now, strangely enough, the government of India seems to want food out of it, which is, which I think is not quite correct, since inflation targeting with the existing index of inflation has been renewed in 2021 after 5 years of the first round. And the final thing I want to say now, whether food inflation is in the target or not, or food prices are in the inflation index or not, food inflation will impact growth. There's no question about it. And that's clearly something which the government is worried about, I would think. Just want to conclude by saying something which has not got very much attention is that the industrial growth or manufacturing growth in the last year was down to 5% from about 8 or 9%. And there's every reason to believe that that's due to high food price inflation, which leaves less with households to spend on non-food items. I'll stop here and come back if necessary.
Sure. No, I take your point, sir. In fact, FMCG company after FMCG company said the same thing, that it's taken away so much of the purchasing power that it is directly related to the lower aggregate demand. Rupa, I would know which side you are, since you were one of the authors of the Urjit Patel report. But let me twist the question a little differently, therefore. Has the Reserve Bank used the word flexible very well? It did look through the high food inflation during COVID years. So, where it is entirely supply driven, they are looking through it. And therefore, right now, do you think there is any need to change the system?
No, I fully agree with you that it is flexible inflation targeting, and plus minus 2% gives enough margin or scope for Reserve Bank of India to adjust for stressful episodes. But, Latha, when we are talking about headline inflation, headline CPI inflation as the nominal anchor of monetary policy, almost 43-44% weight comes from food inflation, food articles. And that is very much the part of cost of living. These are linked to wages, labor market costs, and eventually it impacts inflationary expectations through that generalized inflation. So there is no question of removing food inflation from the overall inflation index, which is being used as a nominal anchor for monetary policy.
All right. Now, Sonal Verma, a question which will be very pertinent to you is that there is a slowdown, right? You were the one who were calling the slowdown probably earlier than the others. And now, we've seen that softness in the second quarter. If there is a gentleman's agreement between the government and Reserve Bank, that we will be in charge of food, if the government were to say, we will ensure that the supplies are monitored or made available. You worry about the rest of the economy, and therefore you cut rates. Because after all, there is a problem. There is a softness in industrial growth. Core inflation is down to under 4%, which is the RBI's mandate. Would that be a fair argument? We'll take charge of food, you take charge of the rest.
So I think the arguments that are being made right now by the government are actually fair, in my view. So if you look at 95% of the CPI basket, which is ex-vegetables, it is running below 4%, and it's been below 4% actually for most of 2024. So this is not a broad-based increase. In fact, if you look at the roughly 300 odd items in the CPI basket, about 70% of the items have an inflation rate that is less than or equal to 4%. So if one, it's not broad-based. Second, the entire argument about, it's leading to second round effects, whether you look at rural wages, urban wage growth, inflation expectations, households, inflation expectations from businesses, None of that actually suggests there's been any spillover. In fact, the trim mean measures of inflation have been, again, below 4% for quite a long time. And third, I think the growth sacrifice is on the rise. Monetary policy needs to be forward-looking. What we've seen so far in the first half of FY25, which is clearly an undershoot on growth, I think the current assumption we are making is that this is transitory and government spending picks up, agriculture is great and second half is going to somehow see a recovery. We need to realize that we are keeping monetary policy tight when the broader inflation is under control and simultaneously tightening macroprudential policies. So when you have the combination of the tight monetary and credit policy in this inflation backdrop, I think the growth sacrifice is much higher than is being acknowledged right now. So it is, at the end of the day, flexible inflation targeting. Are we being flexible?
Okay. No, well, Dr. Balakrishnan, would you have a different point of view? There is a sizable body of economists who believe that growth has slowed precisely because of these other reasons that Sonal mentions. Extraordinary heat, monsoons being very high in some places, government not spending enough. That is a big reason. And Reserve Bank's earlier liquidity tightening for another reason altogether. Last year, the withdrawal of notes, etc. There is a very clear expectation that now as the fisc spends and the Reserve Bank has already made liquidity almost surplus in the interbank system, growth will pick up. And therefore, you should not tinker with rates when the mandate given to you is 4% headline inflation. Your thoughts, Dr. Balakrishnan?
Yeah, I would say once again, it is not in the fitness of things that once a mandate has been given to the Reserve Bank. And let me tell you, I say this as somebody who's quite skeptical about the Reserve Bank's ability to control inflation. And I've done quite a bit of work on this. But I believe that once the mandate has been given, that you should allow them to get on with the job. Having said that, I would say that I don't particularly look at the economy quarter to quarter, but I'd just like to say in the last year, the provisional GDP estimate is 8.2%, which is extraordinarily high by historic standards. Government should be more concerned with inflation control now rather than be particularly concerned about growth. And that inflation control will require control of food prices. RBI has a very little role in this. And I just want to say a final thing. When much is said about let the RBI control core inflation, my work basically shows, and this is published, my work shows that RBI's attempt to control even core inflation is not very successful. And there's a very simple explanation of that. When you raise interest rates, firms with market power will pass it on as higher costs. And the impact of interest rates, therefore, on even core inflation is not very high.
Okay, well, this will become a little academic and I will pursue this line of argument. Give me a monosyllabic answer, three of you, before I take my first break. Sonal Verma, you are for a rate cut in December, right?
I was in favor in October, Latha.
Yeah. Rupa, for a rate cut or no in December?
No.
Dr. Balakrishnan?
I just want to say that I don't think rate cuts really have much of an impact.
No, sir. So, monosyllabic, sir. Monosyllabic. December, rate cut, yes or no? What do you want?
No.
No. Okay, so we have 2 nays to 1 yes. On that note, I take a break and come back to discuss the larger question of whether the flexible inflation targeting framework needs to be tinkered with at all. Back in a minute.